The inside or outside super. So I did touch on that in relation to being able to pay annually in advance. That's a plus. The other big advantage of paying it in your super fund is that it's immune to your daily spending. So as a family, you move from two incomes to one when you have a baby. You're confident that your cover is still paid for from your super without impacting your ability to eat while you're on one income. Your super fund will generally pay 85% of the cost to you personally outside super, setting aside income protection from them. But certainly life and TPD, you don't get a tax deduction personally, but your super fund does. And the benefit, looking at life cover, so a death benefit paid to a dependent to receive tax-free. So you've got a tax deduction for your premiums, benefit received tax-free. Tick, all good. When the benefit is paid to a non-dependent child, that changes slightly. TPD is, again, you get a tax deduction. The benefit paid to you is taxable when you withdraw it from your super fund with a slight adjustment, but it can still work out better because you can leave the lump sum in your super fund. So that lump sum is going to pay 15% tax on its earnings until you get around to spending it. And you only pay tax on the income as you take it out. Whereas if you get a lump sum in your hands and you invest it, you're going to pay tax on that income, even though you're not going to spend it till next year or the year after. There's a bit more analysis to it than that, but the tax benefit's the other one. That's less of a concern for income protection because you are entitled to a tax deduction for income protection premiums that you pay yourself. So the economics are broadly the same. Obviously, having in your super means future use paying it rather than today you. But let's assume that you're going to pay from your super and then top up your super. That's exactly the same thing as paying for it outside super, but it gives you the flexibility to change. And then the final one where it might not make sense is if you're earning $250,000 or more, where you're capped out on your super contributions because you can only put in $30,000 tax deductible each year, and 12% of $250,000 is $30,000. And you're also going to pay Division 293 tax, where your super fund pays an extra 15% tax on the contribution. So that might be a reason to buy it outside super. But for most people earning between 45 and 190, buying it in your super fund will generally make sense. Trauma, you don't get a choice. You have to buy it in your own name. So there's a fair bit of structuring thought to go on there, and that's part of what we will do when we do a piece of insurance advice. So this is getting to the, can I claim a tax deduction for it? So look at in your own name. The only one you can claim a tax deduction for is income protection. Your super fund, though, can get a tax deduction for life, TPD, and income protection. That's why we will almost always, there's no always, but almost always, in most circumstances, buying your TPD and life in your super fund is almost a no-brainer. It's not quite, but almost. Buying your trauma, it's not tax deductible either way, and you can't buy it in your super fund. Income protection, you can get a tax deduction, and your super fund can get a tax deduction. So now there's a choice. But if your super fund's paying for it, you don't get to claim the tax deduction. Your super fund does. So that's the big change. So for most middle income, so anyone between 45 and 190, would generally, for flexibility purposes, structure it in super to the greatest extent possible. And then to avoid the impact on your retirement, then make additional contributions by, say, salary sacrifice to pay for that premium. So economic, same place. You've been able to pay it upfront, get the lower price for annual premiums, have a bit of a breathing space if your income falls, and potentially tax benefits. So for all of those reasons, super makes sense. Where it becomes a little bit more delicate is if you're in that Division 293, so $250,000 of income, or you're otherwise seeking to max out your super contributions. So someone closer to retirement might be happier to get the money into super and pay the bill. You can usually move from one to the other. It's called a cancel and replace. It's a bit of paperwork, but generally doesn't require re-underwriting. So again, that's something you should be thinking about as you look at those life changes that might impact both the level of cover you need and where you should be paying it from. Again, think about those changes.